I don't know. We are live on Oz Property Investor. Bring the big names, and we have the big, mysterious Melbourne Fun. It's going to be a big session. Stay tuned because we're going to talk about the data. We're going to talk about the macro. So Mike's bringing you very unique insights about the truth about Melbourne. Then we're going to talk about some depreciation as well, which is really fun because we're going to show you a real life example of how much money you can save, thousands, maybe even tens of thousands. Maybe that's popping up a bit too much. And we're going to unpack some micro sort of level, Deer Park and Melton, maybe one more, depending on how we're going for time. But big session, team. Stay tuned to the end. It's going to be, how you going, young Mike from Magic Mike from MCG, Quantity Surveys. How you going?
It's like you're apologising that I begged to be called Magic Mike. That is never something I asked for. But thanks, Jeff. I'm doing really well. I'm glad to be back on the show with you guys. We always have fun. So I'm looking forward to sharing some of the sort of left field research that we collect, because we're not buyers agents, but we are sort of property market analysts and commentators to some degree. So hopefully there's some meat on the bones for people.
Yeah.
Well, that's why I like to get you on, mate, is because there's no real incentive, like there's no narrative shift in your data. For you, it's just data. Data is data. You're not trying to push someone to a specific market because you believe, it's going to help you in some kind of way. It is, no, this is the data. This is what I'm seeing investors do. And that's the cool thing about your data as well, is it's literally the only people that get depreciation schedules are property investors. So you have this keen focus on what the property investors are going after. And each time we get you on, one of the surprises is, oh, that market seems to boom about 6 months after you say it does. We got you on, I mean, we've had you 3 or 4 times now, and we got you on talking about South Australia. We got you talking about WA. We got you talking about pockets of Brisbane and Melbourne and regional Queensland. Now we're talking about a different market, mate. So you're probably not going to disappoint us in this one.
We'll see. Time will tell. But you're right. My only vested interest is in success, right? And I want investors to be successful. I don't want them to make poor decisions. I don't want them to buy an investment property that stops them from getting their second and their third. I don't want them to purchase garbage or get sucked down a marketing rabbit hole of no actual substance. So yeah, like that's my guiding kind of principle. Is I want that stat to change, that 72% of investors only ever get one property, because I think there's a fairly strong argument to say that one property is not enough to financially change your life.
Wow, Mike. Gee, it's 90% of investors don't get past 90% around that, don't get past the second as well. So for me, and part of that's a finance piece, but part of it is also buying in, and you have data on buying your backyard as well. So I don't know if you prepared that, but Joe, how are you going? We've got so much to cover, so we'll get through the intros and I want to get straight into the meat and bones. Joe, how are you going though?
Mate, I'm fabulous. I'm ready for this. I don't even want to waste time on how I am. I don't care how I am. I'm just pumped for this. We have a lot of stuff. Well, you care. That matters. We got a lot of stuff to cover off. So I want to dive straight into the meat and potatoes of it. What do we got first up? What's the first cab off the rank that we're chatting to on this?
Well, first thing, we introduce the man, the myth, the Mike Mortlock legend in front of us. You have been in the industry leader of depreciation and managing director of MCG for 14 years now. It feels like it should be longer. And we care, Joe. Exactly. Maddie's got it on. You completed thousands of depreciation schedules yourself and your team, probably many more than that, maybe tens of thousands now. But you are regularly in the AFR, realestate.com, all that jazz, and Pippa as well. You're on the board of Pippa. So
I am, yes. Because I care. I mean, it's the same motivating thing. I mean, you guys know very well that we're swimming with the sharks when we're looking for professionals to work with when we're wanting to invest in property. So Pippa is a lifeguard of the shark pool, I would like to think.
There we go. And interestingly as well, you're an amateur or professional pilot. I'll let you choose which one of that. You're a keen musician, elite amateur athlete, triathlete, which I know we've told that story a few times. So, maybe it's been generous to you, but I think you underestimate yourself. So, Mike, you are well and truly qualified to talk about Melbourne and the truth about the data behind it. So, first off, though, before we go there, I want to learn, what do you see happening with the economy and interest rates? Because you often have that crystal ball and you have You say some very smart words on that. So I want to hear what Mike's take on the economy. Then we'll get to what the macro data looks like in Melbourne. So what does that look like, Mike?
Yeah, look, the thing that look, isn't that a lovely little slide I prepared
I didn't want to
earlier?
waste it. I didn't want to. I feel like you've put some effort into these slides. So let's bring up the one that says interest rates at least.
Well done. I mean, if you want to talk effort, I mean, we could full screen it and not have that top bar. I mean, that is rubbish, Joe. I'm going to have to take a point off for that. But one thing that I wanted to highlight, now, I don't know if anyone has so rich a social life as me that they read the RBA meeting minutes as soon as they come out, but I shared a little comment and they were discussing whether it was appropriate to have a 50 basis point cut rather than a 25. And I think that's a very meaningful thing. Obviously, they didn't go to a 50 basis point cut. I mean, I miss the good old days where you could get massive cuts. It's all these tiny little basis point ones now. I just think, swing for the fence, RBA. But what that did is it changed, it kind of changed the narrative in terms of the rate tracker. So we're now looking over 80% prediction of a cut at the next meeting. All the banks are predicting, and it's different now because we only have 9 meetings instead of 11 or whatever we were.
Only 8. I thought there's only 8 every 6 weeks, Mike, roughly.
8, yeah. And the meetings go for 2 days instead of 1. I don't know what they do. I presume they just have a day and then, I don't know, play putt-putt golf in the RBA offices. But look, the banks are predicting that we're likely to get 2 or 3 cuts. And I think at the end of this cycle, it's likely that interest rates will be 1% lower than what they were before we started cutting. In speaking to buyers agents on the ground, with that first interest rate cut, there was a lot of phone calls of people that were sitting on the fence because prior to that cut, we had quite a bit of rhetoric about the direction could still be up. We had sticky inflation. We had sticky services inflation. That was a big one. And there was an argument to say, well, we might actually need to go up a little bit before we go down. I think as soon as we got that basis point cut, it might not be. What I want to say is that the response was disproportionate to the stimulus. 25 basis points doesn't make that much of a difference, but the response was pretty big. And I think what we were seeing there is it was really kind of a confirmation that the trajectory was down rather than up or flat. So the next slide I wanted to share is some research that comes from the chief economist of the Bank of Queensland, looking at what actually happens in the 2 years after an interest rate cut cycle. And if you look at the data there, what they actually found is in 8 out of 10 cycles, they saw national property prices grow by more than 10%, and in 3 of those, growth topped 25%. So I know we wanted to talk about Melbourne, but I just also wanted to take a minute to say, is it a good time to buy? And I think any time that we have depreciating interest rates, then the answer is quite often yes, unless we're in some crisis situation. But as we even saw with COVID, we had a crisis, interest rates dropped, and we had a very, very sizable boom. So I expect that, we're 6 months into the year and we've had a 1.7% national growth of the property market. I think the back end of year will be better. I still think we're probably going to sit somewhere around the high 4% nationally, but you can't buy the median of the Australia. You can't buy the median of the Melbourne, right? So I just wanted to make the macro point that I actually think it's a good time to purchase. And I think in 26, 27 is probably when we start talking about being in a boom again.
Yeah. And this is actually super interesting because every single interest rate drop has seen stimulus coming into the market and has seen property prices grow. And over the past 20, 30 years, it's been 15% or 12%. Yeah. So 32, 27. But that's super interesting. I didn't actually know that every single time there was a positive. Very, very interesting. Okay.
It's a good correlation. See, I promised something left field and there we go.
He's already delivered. So much more to be delivered. What I want to say is we may have time for a third suburb. So if you have a suburb of Melbourne you want to understand, preferably in the east, let us know now because We may have time to get to that data. I don't think we will, but drop your favorite eastern parts of Melbourne because we've got the bias apparently for western suburbs, but that was pure viewer's choice. Mike, that's exciting because it's interesting. Just a reason why I feel that's relevant for the Melbourne property market in particular, because I hear in a lot of rhetoric, you've got this whole, once rates start to be cut, you'll see more interest in the Sydney and Melbourne markets, which, yes, as the media is obsessed with these two markets, which there's many properties and valuable locations outside of these two. But that's why I thought it was relevant to bring that up, because that's the kind of really macro high level economics. So, Mike, what's the first what is your general sentiment? I don't know the order we're going to go for the data, but we're going to talk about what the sentiment was in Melbourne 2 to 3 years ago and what that's how you felt, because that's when land tax was in its full swing. COVID lockdowns are still a thing. And there was the ring of steel around Melbourne. So how was that feeling 2 years ago versus now? What's happening there?
Yeah, that's kind of an interesting topic, isn't it? Because why did the rest of Australia boom and Melbourne, in fact, go backwards? Like what? What? Yeah, keen to hear your thoughts.
And the reason why I kind of wanted to go backwards is because I think we need to know a little bit about the recent history of Melbourne to understand the dynamics at play and why it is a city that had the third highest median price, and now it's like a mid to bottom packer. So what actually happened in Melbourne? And it wasn't just land tax. You could argue that it started with the minimum standards legislation and some of the Residential Tenancy Act changes, the no cause evictions and those sorts of things. But if Joe, if you wanted to pick up on the slides, we saw Melbourne hit the peak of the market in March 2022. So it had a run during COVID, like everywhere did, but the minimum standards legislation was a little bit of a headwind. But of course, the big one was tax. But the last point on that slide, that figure shows the percentage of property investors in our data. So when we're doing depreciation schedules across the country, we can see what percentage of investors are buying in Victoria versus New South Wales versus Queensland. We had about 13.8% of investors buying in Victoria. Over the long-term average, it probably sits around about 16%. But one thing that we shared when the land tax was legislated in Queensland is we looked at really the 100 days before that land tax change and the 98 days that it was legislated to come into effect. Of course, it was repealed before it actually happened. And we did see a 17 basis point drop in investor activity in Queensland. And of course, I will share the data on what's actually happened with Melbourne. If you go, say again.
Yeah, since that changed, like what happened when they got it, like it got repealed? I think we did a special announcement when that all happened, and I mean the Brisbane market, Queensland market as a whole, really has gone absolutely. Oh well, here's a slide. Actually, here's one you prepared earlier.
Well, the next slide after this will show the latest CoreLogic data, but this is a snapshot of the peak of the market for Melbourne. So you can see its median value was 805, which put it in, it should be third place. Yes, third place after Canberra. No one really sort of talks about Canberra because it's a bit of a weird place. I always kind of think, Sydney, then Melbourne, and Canberra into the mix. But of course, the median house price in Canberra has always really been higher than Melbourne because public servants get paid a hell of a lot of money. And they love the Labor Party as well, which is an interesting observation. But you can see there that Melbourne had an annual growth rate of 9.8%. But interestingly, it wasn't galloping away like Brisbane and Adelaide and even Sydney to some respect. It was somewhat subdued. And I think part of the problem kind of speaks to the headwinds of Melbourne. And I've put a slide about the headwinds because I want to talk about this theory of mean reversion as well, but we'll save that for a second. On the next slide, you'll see the latest data. So this was the May data. So the index has it the 31st of May. So you can see Melbourne, the median value in March 2022 was actually
741. Lower.
Yeah, it was actually over
Yeah, it's in
800
the
and
negative.
yeah, now it's
Sorry.
791. So yes, we've seen some green shoots, like 1.2% for the quarter, another 0.4%. I think what's interesting to note is the data lag. I think Melbourne has been doing quite a bit. There are certain pockets that probably have seen double-digit growth already, but we can only really look at this macro data, and it's not showing that much of a story to us yet. Interestingly, it's showing Darwin, and Darwin is probably a whole other episode we won't talk about for that one.
So again, Mike,
yeah,
for those interested in Darwin, we did a session
4%.
about 6 or 9 months ago on that. So I'm not saying there's no correlation does not equal causation, but Oz property does not equal. We've certainly not. I mean, I haven't seen too much buying personally myself in Darwin, but it is a very interesting one. I've been talking to Joe about it for about 12 months now. So yeah, maybe we'll push that.
Maybe we'll have an Oz property purchase in Darwin if Jeff has his way.
Roll the dice.
Maybe.
Roll the dice.
Right, yeah,
and if you scroll across to the other side, you can see the 5 and 10-year growth. So it's interesting. I like this one as well because we all know what Perth did in the last couple of years. But if you look at Perth's last 10 years, it's only grown 58.5% compared to, Brisbane and Adelaide over 90%. And really, it's just kind of matched Sydney over the last 10 years. I know there's always a guy that comes on that says Sydney is king. Cue that bloke into the comments now. This is probably the appropriate time, although it's not as kingy as Brisbane and Adelaide have been. But you can see here it's calling Melbourne the peak of the market was March 2022. That's why I shared that slide. And we're down 4.5% of the peak. I mean, the property market declines in Australia, you go back, to the 70s, we haven't really seen any decline into double digits. Like we can see national house price booms in double digits, but we never see declines in double digits. In fact, most times the decline nationally is, really capped at around 5%. It sort of speaks to the robust nature of it. But this slide I really like because it does kind of beg the question, okay, well, if Melbourne has underperformed so much, then it only has one way to go. That's the mean reversion idea, is that it should trend in a certain direction. And if it hasn't, then it eventually will have to catch up. It's not a scientific fact, and it kind of relies on the fact that the market, or let's say the asset itself, is fundamentally the same and it hasn't changed. But I would say that because of things like minimum standards legislation, like the land tax, like the ring of steel that the Victorian government is still paying for, that Melbourne is fundamentally a bit different than it was before, but it does certainly show tremendous upside. And what we did as a research report a couple of months ago is we took the hypothesis, okay, well, if Melbourne goes like this, normally, let's get a valuation of certain suburbs of what they are now and what they should be if it had gotten that trajectory. So again, I'm not a hot spotter that says, you should buy in this suburb or that suburb, but I can certainly show you the suburbs that have the most potential upside had they tracked to that mean. So that can potentially show some pent up kind of capital growth in them potentially.
Can we just, before we do that, I'm just going to put this out. When we're talking about this potential growth, this is not financial advice. I mean, this is Mike sharing his company's anecdotes, and not anecdotes. It's solid data. It's legitimate data. But just go and crunch your own numbers. It's like any data platform that is always discussed about. Make sure you align that to what you're looking to do and achieve. But should we unpack that? Joe, you had a question.
Yeah, I want to unpack that, but just one small point that I want to make is 2022, Perth did 7% annually change in dwelling values, right? So when you look at these charts, you can't just if you look at these charts, oh, well, look, Brisbane and Adelaide and Hobart, they're Sydney, 17%. And then here is little old Perth at 7%. If you bought any of these markets for a $500,000-$600,000 property, the best one you would have chosen was Perth. They've had an absolute tear. So you can't just look at these charts and say, oh my gosh, well, right now Perth right here is the best. It's at 8.6 for an annual. No. You're going to be making mistakes if you start trying to buy what is the highest. You've got to do a little bit more digging. I mean, that sounds like an obvious one, but I think when people see these types of charts that CoreLogic puts out, they just make the assumption that, cool, well, that must be the best place to buy then. No, not necessarily. We've got this slide here, Mike.
Yeah, so this is me sort of giving a little bit of a timeline. So May 2023 was when the land tax was basically announced. That happened on the 1st of July. So I showed before that we had a 13.8% of property investors buying in Victoria. Post the announcement, that immediately dropped to 5.2% of investors. So people really, really voted with their feet. And that is the go ahead.
Can you just before you to go into the next step, can you just talk to what that is? Like, when do people come to you, and how does that relate to the data that you collect? Because from 13.8 to 5.2 post announcement, that's a very short period of time. Like, how does someone go to you for you to get that data to be able to flag it? Because
it's a good question, and the methodology is important to understand if you're wanting to rely on it, really, because we need to look at properties that were purchased and the settlement date is not a long way from when they got in touch with us. So, for example, if they bought in Victoria and they didn't get a depreciation schedule for 2 years, well, that kind of isn't speaking to that. So we're looking for people that exchanged after the announcement of that was happening. That's where we came to a 98-day period in Queensland. There was really 98 days we calculated that someone could buy in full knowledge of the fact that that was about to happen. So in Victoria, we were making sure that we're looking at exchanges that happened after that announcement date. So again, we look at every state around the country.
The grab is just straight away. It's like it's this is when the property exchanged. This is when we're running the report. This is when we're running the data. So it's bang on. You can lock down a date.
And 6 years ago, it took on average around about 400 days for somebody to order a depreciation schedule. These days, it's around about 70 days on average. I think buyers agents can claim a little bit of the credit for that. They have embraced tax depreciation in a way that other industries like mortgage broking haven't. They understand that cash flow is really important when you're trying to build a portfolio and hold on to the bloody thing.
Probably accountants as well, wouldn't you say, Mike? Accountants.
You would hope so. You would hope so, Jeff. I spoke to Jeremy Yanazelli about this a couple of years ago, and he said, I used to refer a bunch of them, but by the time that people come to me now, they normally already have an expert that's introduced the concept of tax depreciation to them. So I really only ever used to sort of talk to accountants and sometimes property managers. These days, buyers agents are much more in the mix of people wanting to connect their clients with tax savings. So good on them. The next slide probably is actually a better way of showing what happened here. So in February of 2024, what we actually did is we commissioned a research project where we looked at the number of properties that were identified as being rental properties that were sold. And we also looked at investor lending in Victoria, which we saw decline. And we calculated that there's likely to be a net 1% contraction of the rental pool in Victoria. Now, that was it's over a year earlier than the rental bonds data that just came out, and their data showed a net loss of 24,000 rental properties over 2 years. So actually almost 3 times bigger than we predicted a year earlier.
You outperformed, which in this case, I don't know that that's a great thing. You under promised and over delivered, but maybe you needed to over promise and under deliver in this situation. But
I think so. I mean, under promising and over delivering is a value that we have here at MCG. But in this instance, the reason why I have an interest in this is I want to actually put this in front of policymakers. That's part of what we do at Pippa, but for my own purposes as well, if there's a bad decision or if there's something that politicians or policymakers don't understand has unintended consequences, I want to do what I can to put that in front of people because, of course, as a property investor, it impacts me, but I do feel a responsibility as an analytical person who likes doing this anyway to put this in front of people. So I was trying to sort of show the case that this Victorian land tax is making property investors exit the market. We just didn't get those numbers quite right.
Why is it because it's an extra it's an extra like $1,400 on a $500,000-$600,000 property. So is it more of a perception thing of like, oh my gosh, there's land tax we have to pay, this is the end of the world, we're not going to do this? And or is it just or is it that's a massive financial constraint, we need to get the hell out of here? Did people crunch the numbers on this situation, or how do you think about it?
Yeah, it's a good point. I think land tax is the easy one to zero in on, but it's bigger than the land tax. As I said before, the minimum standards legislation, the residential tenancy legislation, and also this idea that ring of steel that they put around Melbourne, that was bloody expensive. In fact, I've got a slide at the back end showing the actual state of Victorian debt. This COVID levy, this land tax was really only supposed to be a 10-year impost to property investors. But I say once they get drunk on that revenue, good luck, trying to wean them off it in 10 years. I really believe it's here to stay. So
every other state is going to roll it across. They're going to start opening it up to different trusts and structures, and all of a sudden we haven't got a choice as a country. They're going to start.
Well, you have a choice. You get into politics and you run against that campaign. But then if you're in the minority as a property investor, then
they're both.
I've said
what if both parties take it on?
I've sent too many dodgy texts to probably both of you over the years to run for politics myself, but I'm happy to feed one of you guys the data. I also made a point in that research that Victoria accounted for 66% of the national drop in rental properties, but only has 25% of the population. So that's us taking a month snapshot and extrapolating that over 12 months and coming with our best idea of how many dwellings we were losing. We missed it by a little while. But we also factored in the net loss. So we were looking at investor lending and investors coming in to replace some of that stock, whereas rental bonds wasn't. So it probably wasn't that far off, but still, it was far worse than we expected.
Could I point out though, Mike, that and everybody watching, that Victoria had that tremendous run. It was one of the most consistent property markets year on year. And they had and yes, maybe that policy, are we sort of letting the tax policy wag the property growth tail? Wasn't just set to kind of take a bit of a breather anyway? I mean, I don't know, maybe that's controversial. I've thought that, and I haven't mentioned it too loudly because you get shot down, but yeah, I think definitely.
Let me give you another contrast. So for example, I did a bit of a comparison of Perth versus Melbourne about a year or so ago, where I looked at a market that was there or thereabouts, peak of the cycle to bottom of the cycle, and I compared some of the tax policies or some of the legislation in and around housing. For example, the Airbnb tax in Victoria, a 7.5% tax. However, in WA, they had the same issue. We don't want Airbnbs. We want properties on the long-term rental market. So did they tax people 7.5%? No, they actually gave a $10,000 bonus. So it's just little things like that that say, okay, well, states like WA are open for business for property investors, but Victoria isn't. There was also, the vacant property taxes and a few other things that kind of got wrapped together. So I really think during lockdown, we saw Melbourne really suffer in terms of the high density apartments. So we were tracking vacancy rates that were double digits. I mean, it's crazy to think of vacancy rates in, CBD apartments in double digits today. But that's actually what happened. I worked with a property manager that was purely property management. They worked in a lot of apartments in Melbourne. They set up a sales division because all of their property managements were wanting to sell. And they're like, okay, well, if our rent roll's disappearing, we may as well clip the ticket on the way out. You know what I mean? It was a crazy time. So I think when we shut down the students that were occupying the shoebox type apartments in Melbourne, the sheer cost of winning the global record of lockdowns belongs to Melbourne. I mean, it's amazing. You ask someone from Melbourne and I say, it was 270 or 290 something days. They always know the exact number. Anyone from Melbourne in the comments, I can't see them. But if you live in Melbourne, put that number in there because I bet you know what it is. And of course, that impacted economic activity. It impacted construction. It impacted the actual coffers of the state. So I just think you're right, Jeff. It does sort of seem in some respects, okay, well, we know land tax. You can go and look it up and see what it costs. So it seems like a disproportionate response. But I think you've got to add all of those things together to really understand why Victoria became so on the nose for property investors.
Yeah.
The other question I have is the vacancy rates of Victoria. 25,000 properties disappeared from the rental pool. But the right now the vacancy rates aren't 1% in Victoria. I was just trying to find the data of what it is right now. If anyone else is on a computer and has access to that data, I usually have it. I just don't have it in front of me. But it didn't fundamentally change too much from a rental market. It didn't make the market incredibly tight.
Yeah. But I suppose a bit like the whole country, that I think in many respects has been disincentivized from investing. I mean, we had 2 federal elections with negative gearing and CGT on the chopping block. I mean, that happened in this election. People sort of say, nobody talked about negative gearing capital gains tax in this election. They did. It just happened a lot earlier than it normally would. There was a period of a fortnight where I was asked by a journalist, what would be the capital gains tax discount on Anthony Albanese's Dulwich Hill property? Then they asked me, what would be the after-tax cash flow position from a negatively geared standpoint? And then he bought the investment property in Copacabana in the Central Coast. And again, I got a tax question about, can you help me model what that would look like from a tax position? So journalists were certainly talking about it and angling that into the conversation. And I think as a country, we don't have a politician brave enough to recognize the value that property investors bring to the country, not just in taxes, but providing rental accommodation. So roughly, you go back a long time, maybe 70 years, roughly a third of us rent for a number of different reasons. But if we have a third of all dwellings available to rent, we're talking about, in excess of 3 million dwellings, whereas the government owns about 383,000 dwellings. So without property investors, the government has a big problem because they're out of that lending business. And we've also got to understand on the back end that people that take control of their financial future by trying to invest in property are most likely to kick themselves out of that pension when they get asset tested at the back end. And if you look at government expenditure, welfare is number one. We spend more on welfare than we do hospitals, more than education, more than defense. And a big chunk of that is the pension. It's not just, people on unemployment benefits. A lot of that is the pension. So to penalize people that are just trying to make prudent financial decisions for their future, I think this country's really got it wrong. Joe Hockey talked about, what was it? You're either a learner or you're a leaner or something like that. I think we need to really kind of recognise aspirational Australians that are trying to sort of self-fund their retirement.
Yeah. That was you got on the soapbox there a little bit, Mike, which is fine. I want to know though, because I'm just mindful. We're at half an hour in. We have a couple of suburbs. I want to know the truth about Melbourne, and you mentioned something that was very interesting. That I said that there was sort of a catch up versus what growth could have been in certain suburbs. So I think we should throw to that. That sounds quite interesting. People would definitely be interested in that. So let's get those slides up. What are we sort of seeing? Which suburbs
Melbourne
are around?
Price gap and reversion potential.
Yeah, that's probably it. I'm just trying to find that slide for you as well. Yeah, there you go. MCG's mean reversion research.
Oh,
cool. This one?
Yeah, that looks.
This one?
A bit further.
This one?
I think you've gone too far, haven't you?
It's the one after that one, Joe.
Here we go. We've got
this
some juicy
one
suburbs.
after that one.
So we've gone too far.
There you go.
Wow. Okay.
Here's
Stonington
the growth. Great property. Oh, scan the QR code to get our report.
That's double on
well placed.
Yeah. Sorry about that. My marketing person did that. You don't need to give me your details. I mean, I'll send you a copy of the report. It's a free research report we put out in February. So what we looked at is, well, let's apply this thesis. Let's apply the mean reversion, and let's look at a couple of suburbs that were probably investor focused. So these were the growth gaps that we found in these particular suburbs. So Wyndham, obviously that's a big 32%. It's a lower price point, so that only represents a $212,000 gap. But yeah, Sunbury, Darebin South, Yarra, Port Phillip, Stonington East. I mean, these are
fairly blue chip sort of parts.
Some of them are.
What is this? What is these words? What do all these words mean?
It means basically, Joe, if you didn't have that, you would go on. Sorry, Mike.
So if we didn't have, so what we're saying is if in 2022 Victoria didn't get all of these naughty rules that turned everyone off, it turned us all off. We weren't buying. The supply and demand didn't make any sense. Like Jeff, we were talking about South Australia, we're talking about WA. Things were starting to heat up. And if it continued down the path of like every other state was going without these silly rules, these are the prices that we should have seen if it followed the correct mean growth.
Yes. Yeah, not nationally. This is actually Victorian, or I should say Melbourne specific. So if Melbourne just did suburbs, what it normally does, its normal trend line, and it didn't get to 2022 and then go in the toilet, these were the suburbs that we identified as having some of the biggest growth gaps. So, I mean, the reason why we put that out there is not to say buy in Port Phillip or buy in Sunbury, but just to highlight some areas that show a big gap from where they could have been if it followed that trend line, because some other suburbs might have overperformed. So there might have been some suburbs that, are only 5 or 10% short of what the normal trend line would be. But these ones are actually have a lot of upside potential. So if Melbourne does revert to the mean, we're highlighting a couple of places here that have some pretty solid upside.
That's massive. $500,000 in Stonington East. Massive. Port Phillip. Which are the affordable, the more affordable, Wyndham is a more affordable market there.
Yeah, Wyndham and Sunbury.
Look at the percentages, Joe. Look at the percentages based on Sunbury's very affordable, because 43% of, you're talking, that's a median house price of roughly about 450 to 500, because 43% extra would make about 750 approximately.
And the report does show the medians. I've just tried to chuck that in a one slide version there for you guys.
Yeah.
Wow.
Yeah, that's incredible. So that's something to, that's keep an eye, see what happens. I mean, look at all the other trends as well. Look at the supply and the demand of those areas, but that's super promising.
Which stay tuned, because we are going to unpack some supply and demand metrics in particular areas. So you'll actually go and see, because this is one side of the story. You should never look at any data piece in isolation. You should validate and look at it as a whole picture, and then start to have the conversation with the property managers, which I did a bit of that about Melton earlier this week. So how many more data pieces do you have, Mike? Because I'm just mindful we're at 40 minutes and we've got a lot of depreciation to share, and we need to throw to our first sponsor. But
no, that's okay. Well, what I think we probably should do is there's a slide that says, what does the data really say? That's a big grab of that one.
Juicy.
So
yep.
Yeah, so that was some research that we prepared earlier in the year. So what we can do within our business is we can say, okay, well, where are property investors buying around the country? And you talked about Perth. I mean, Q1 2022, about 9% of property investors were buying in Perth. That jumped to 22% Q1 2023. And in our data, it peaked at over 40% of all property investors were buying in Perth, which is bananas. Queensland and Perth have been the two states that have been fighting each other sort of neck and neck for the last little while. In 2024, Queensland just outpaced WA, and the number one statistical area 3 for 2024 for all of the investors that came through our doors was actually the Townsville statistical area 3. So you'll certainly see Melbourne represented. You'll certainly see Perth represented, but yeah, Townsville was the big one. So that's the data that we have that comes through our doors. We also did a research project where we looked at properties that were advertised for sale that in a particular month, I think it was February this year, that we could see had actually been these were properties that were purchased in February, and we saw them enter the rental market. So we know that these are investor purchases. So that slide shows the national top 20 regions extrapolated from that data. So that's not the people that come through our doors. That's national data that we're actually able to source to be able
Melbourne
to present.
West is on top for those listening, which and then you sort of go to the Gold Coast, Perth, Southeast, Melbourne, Southeast. I think, I suppose keeping some of this in mind is it's going to be potentially where there's a good amount of properties. So I suppose, yeah, because Southwest, yes, there's probably a lot of investors got involved down there as well. But
it's ranked in terms of new rentals, but if you can see the new percentage of rentals, that's probably a more meaningful way to sort of categorize that.
I need to make that a
yes,
bigger
Adelaide North 10. Sorry, I realised. Now we can only do so much. Melbourne West 135 new rentals, so 5%. So what does this data actually tell you? Like, what are you pulling out? What value as an
this is where property investors were buying. So this is a snapshot from a couple of months ago, and this is where property investors were actually transacting. So, we talked about Perth, we talked about Townsville, but we can actually see you can see some of those locations in there, but you can really start to see Melbourne hitting the charts in a way that it hasn't before. I mean, we talked about it being around 13%. Pre-land tax dropping to 5%. These days, it's in the low 20%. So it's a bit higher than the long-term average that we've seen in our data, and I think it's probably it's only going to increase in the next little while.
There you go. Interesting, isn't it? Yeah, which kind of maybe and the data in terms of the price and the days on market, all that is typically lagging by about 3 to 6 months, depending on how long sort of settlement periods take, like typically at least 3 months, but anywhere up to that 6 to 9 months, you start to see. So that's something that when you're looking at things like a hashtag, like a DSR, all those sort of platforms, or even if you're not subscribed to realestate.com, you need to consider that you need to then jump on the phone and have that conversation with the property managers and even the real estate agents to some extent. They'll tell you that, yeah, it's going to boom, like you got to buy now. So they'll create that FOMO for you. But so take it with a grain of salt, but just understand what the sort of list versus things are actually, how quickly things are selling for as well. Should we? I want to throw to our first sponsor, Joe, and then we'll get to. I reckon we go to a suburb, and then we'll look at some depreciation triggers. So stay tuned. We're going to look at. I think we'll look at Melton first. Why not Melton?
Let's do it.
'Cause it does prop. No.
Oh, Jeff, I wish there was 3 investing books that covered everything property.
Oh, Joe, there is. Steve has 3 books now.
That I do, guys. I've got 3 books now. You probably don't even have to follow this group anymore. Just kidding. You want to keep seeing and hearing from me, of course, so stay involved. But in all seriousness, if you want to get the full picture of investing, residential, commercial, and development, these 3 books have you covered for the fundamentals. For OzProp members, here's the best part. I'm giving these books to you for free. Just cover the postage and I'll send them right to your door. Go to policeyproperty.com or click the link below and get your copies today. You can also get all my spreadsheets, checklists, and resources free on my website. Happy reading, gang.
There we go. You don't have any tiny time to do anything. Policey doesn't stuff around. He's on holiday again. How dare he do that? But yeah, he's still working very hard. I imagine I saw him with some. But yeah, Clint raised a very good point about building approvals and potentially undeveloped lands, which we'll go into. I think we'll see a bit of a story in Melton, which doesn't necessarily. So these suburbs we've come up with, they're the top ones that people said they wanted to hear about. There was a couple in there that were sort of tied, sort of with a similar number of votes, such as Richmond in the east. Which I just thought Richmond, and I was packing them as well in the east. So depending on how we go on time-wise. But Joe, do you want to bring up some H-tag data and let's talk through this? And then we'll go, I want to throw to some depreciation triggers because we have a lot more to cover off. So stay tuned. And Mike, what's off the top of your head, do you have much insight on, because you have data at the SA3 level, if I understand correctly?
Oh, mate, all levels. We can do your SA2s,
course.
your SA4s, we can do LGAs. No limit,
the address.
He's
got
we did
actually data.
We did actually do a research project that the media picked up and called it the NIMBY list. And what we were looking at was locations that had less than 2% increase in new dwellings from the 2021 census. So that's a research report we're happy to give out free of charge. And I thought interesting to throw in there because we were talking about Melbourne, but I think it was it Bundora Council or Burundara Council and Stonington. They were averaging 10 to 16 basically objections to DAs on average for every DA submission. So that
DA.
I know
that's a ridiculous amount of. One person says, "I want to develop my house," and 16 neighbors come up and say, "No, I don't think so."
Is that where Policey lives? Maybe.
Yeah. We really need the federal government to sort of, I know I heard some podcasts talk about it, the Liberal government sort of say that they were going to do some cut through and just say, well, no, this is essentially laying down the law. Unfortunately, that's not going to happen, but that's okay. But it's just some interesting policy thrown around. But going back, I think, Joe, with Melton, you probably need to look at one of the, because that median house price seems a little high, 860. That's
this is combining all of it. So where in Melton do we want to?
Well, just chuck in, if you chuck in Melton, the suburb search, just go to, you don't need to, just literally chuck in the search on the right hand side. Go to, on the right hand, no, there you go down.
Melton.
Yeah, but it's easier. Yeah, that's the one, because this is central Melton. So there's a couple of so one thing in my information that I was told, be a little bit wary, and this is purely we need to sort of look at, yes, once you've decided on an area or considered an area, you need to then validate that information by speaking to your property managers and understanding how it matches with your brief. So we're not saying buy Melton, we're not saying buy Deer Park. But yeah, go back to it. We're just literally showing people what they should be considering, some of the things. So if you're looking here, one thing that you want to, I'll talk to do you want to talk to the demand pieces, Joe? And
Sure. Well, one of the things I think that's worthwhile looking at, and I think it's good to have areas as a bit of a comparison, right? So one of the areas, what was that? Was it bloody Coolinggup? What was the area that you were 3 years ago?
Hillman, Coolinggup, whichever one, yeah. Both of them.
Yeah, okay, let's go Hillman.
Hillman.
We were talking, we did a big, like we were buying, talking about buying excessively in WA, as we kind of said, but look at the capital growth score. So this is one thing to look at, RCS score. We had Mattia on, who went deep into all of this platform is and how it all kind of works. Do we have a code, Jeff, that gives people like 20% off, or is it 25? Like what actually is it?
I was going to say, let's show people the platform before we do that. So
okay.
there may be,
well, whatever.
Yeah.
Just do. I mean, data's. But one thing I look at is this area, like where we were looking, has 90% growth in the past 3 years, 16% growth in the past year. In the past quarter, it's grown 2.37%. So when people are like, "Oh, Perth has had its dash," it's grown 2.37%. Like it's not. You're still going to make some money if you're buying in Perth. Now, I think that if you do buy in Perth, you're very much at the peak, so it wouldn't be something I would be having a long-term hold in. But when you go to places like Victoria, these are some of the more numbers that you should expect. A 1.6% drop in the past 3 years. In the past 12 months, we have a 0. So prices have remained the same for the past 12 months, but now we're starting to see properties bounce off of the bottom. So we've got now a positive quarter and a positive month. And these are some of the data points that we were seeing back in 2022 or 3 or whenever we had that session.
2021 was when it first, yeah.
Was it? Yeah. So this data was not 90%. So, having no growth doesn't mean you're going to have growth. There's more to it than that. But if you look at, we're back into Melton, 5% growth from a rental standpoint. That's really interesting. From a yield perspective, where are we at? 4% yield. This is actually the biggest thing that I want to put out there to all investors that are considering the Melbourne market or the Victorian market. The gone are the days where you can buy a $500,000 property and have a 6% yield that is going to grow $200,000, $300,000, $400,000 in the next 3 years. These yields do not exist anymore, and you can't expect that to continue to happen. So if you are going into the Victoria market, it is one of these it's one of these expectations of like, oh yeah, you guys were talking about buying a $400,000 property. It's now $800,000. Yep. And it's bringing in $650 worth of, rent a week. Yeah, not anymore. So just know that there's going to be some at a 4% gross yield, that's probably $20,000 of negative cash flow that you're going to have to carry. So don't go in there expecting these incredible yields and incredible cash flows, because they're just not there. But
yeah,
the data isn't reflective of accurate growth because there is a mix of new builds.
Yeah, we need to point that out, because that's the sort of thing that data is fantastic. Relying only on data, and that's one thing that Mike brought up as well. He's sort of saying, despite a slight approvals, City of Melton remains Victoria's leading local government areas for housing development. So they've recorded close to 9,000 housing approvals. So, which is a lot of supply for an area. Yes, there's population going there, and I would say that Melton is likely going to be a growth corridor. And Mike, you're probably getting a lot of reports from out that way as well, aren't you?
Yeah, we are definitely active there in a number of different suburbs around Melbourne. That doesn't, as you say, the data is only one thing. And I think when we're talking about medians, we do need to understand price segmentation. So if there are new ones going in there, typically they're more expensive than the established ones. So you could actually just have new housing development being sold and people saying, oh, look, it's grown by 10%. I'm like, oh no, it's just different things are selling.
Yeah. An example that I saw the other day in my area, Wongawilli, it was about 1.1 million, and now the median house price of the area was now 950,000 within a quarter. So you're thinking that's capitulated, but no, that's not the case, because what's happened is there's only about 20 to 30 sales in that area, which is then skewing the per year, which is skewing the data. So you need to really, I'm not saying that that's because there's new builds going on, but there would have been some new builds that had come to market. Now there's some resales of different types of properties. So just be mindful.
You have houses on the hill that go for a lot more. And I guess this is what I like about the hashtag platform, is that you have the ability to search by confidence of data, and confidence of data is just how many sales there have been, because with more sales brings more data, which brings you more confidence. So you can then filter out, okay, well, Melton has 28 suburbs here. 52 suburbs here. How many have high data? 20 entries. So that's going to quickly break down and give you the insights to that. So anyway, going back to it, the median house price of what you can kind of buy in at the moment is $537,000 with a $415 a week in rent, which is a 4% yield. Any other valuable things that are jumping out to you, Jeff?
So I'll quickly just run through, because I'm mindful we're going to get to the depreciation. So IRSAD, so something and Melton has a reputation. You aren't buying in Toorak, to put it in. You aren't buying in Mossman in Sydney. You're not buying in Cottesloe or you're not buying in kind of the ritzier part of Newcastle. I don't know where that is, Mike, but you could probably fill us in.
The Hill, say the Hill, mate.
The Hill. Sorry, but no. So you are. That's something to keep in mind, and where you need to lean on your property managers to understand the pockets where you should be maybe being a little bit cautious, and you can look at data as well. The other thing, Joe, is days on market in those sort of pockets. Look at inventory and affordability are the types of things which you can quickly race through, and
well, some of the. I mean, I know we're just jumping all over the place right now, but this area here has high confidence in data. So I don't even know how to say this word. Strathalua. Sorry.
Strathalua.
But it has an IRSAD, which is social economics, right? It's an amalgamation. This is essentially the government has amalgamated all of the data that they can get from the census and put it into a score to rank from worst to best, 1 being the worst, 10 being the best. But this is an IRSAD of 8, and the median house price is $630,000. Taylor's Hill, IRSAD of 8, $800,000. IRSAD of 7 and $1 million. So very interesting.
Look
so
at those
we can look at the
vacancy rates, though. Jeez, that is, that's telling a story. Why it's sort of still relatively affordable. You're looking at 6%, and so there's a lot of building activity going on. A lot of investors. In there. So,
wow, 6%.
Yeah,
that's incredible.
And inventory is sort of ticked up, and so
there's a story for you in Melton. So if you're going to go ahead and buy in Melton, the lowest suburb is the Melton suburb with a vacancy rate of 2.72%. Inventory super low. Days on market incredibly, like things are flying off the shelf quite quickly, but 2.7% is not a tight market. Someone in the comments said that the Melbourne market overall is a 1.8%, but in Melton it's 2.72. Not saying as well. I want to put it out. And a 1 and a 2, right?
I think it's like if you leave your bike out the front of your house, in only 1 occasion out of 10 would it still be there. Whereas in Taylor's Hill, 8 occasions it'd still be there.
8 out of 10.
That's a new way of thinking about it there, Mike. No, but and it shows the challenge or the difficulty or the flaw in looking only at one data point and saying stock on market is low, inventory is low, days on market is low. But then you need to consider, okay, is my property going to be rented out? Are there a lot of investors already starting to buy in, or are there a lot of bills that are coming in? That's where you look at your building approvals, and are the locals able to afford in that particular area as well? So I think that's a nice little, it's somewhat affordable. Like it's not unaffordable, but based on the IRSAD being one, it's not particular, and this is in years to own. So
the other thing that I want to mention about this IRSAD, because what I start to hear is people ruling out areas based on the IRSAD. Oh, the IRSAD's it's one. If you're buying at 400, 500, 600, 650,000, it's going to be low, right? It just is. Like it is going to be low, and you should expect that. But also, this data has come out in 2021. So the most recent census data for the IRSAD is 2021. So it's not just about what the data is. It's also having conversations, seeing what areas are gentrifying, what areas are changing, because what you'll start to see is an area may be 1 and it will make a shift to 3. it's going to show up in the data in 2026, and then you're going to be interested in it, but it's too late because the gentrification has already happened. So you can't just be a spreadsheet monkey. You can't just say, well, ruling that place out, not going. Well, no, you need to do a little bit more research. And Jeff, you said that you spoke with property managers for this session. You actually,
well, I mean, when I say spoke, I sent a Facebook message or two, and they suggested that that Melton South, they say that it can be a little rough. I mean, not to disparage anybody living in Melton. Look, I live in a rougher part of town as well. So yeah, you can still see capital growth. Like you saw Logan, you've seen Elizabeth, you've seen Mount Druitt, all these areas. So just be mindful that where the property owners are saying that they have some challenges, that not expecting that, yeah, you might have some troublesome tenants occasionally, not every time, but just you have to understand what you're investing in. And if you're not, if you're expecting, and yeah, you can have troubles in any area in the blue chip sort of Toorak or Mossman, or even sort of
What are your thoughts on Melton, Mike Mortlock?
I don't go to the point of zeroing in on particular suburbs, and there's not that sort of much meaningful that popped up in our data, except for building approvals. I mean, building approvals across the board are down. We're around about 30% down on that 1.2 million home target, which needs us to build 240,000 a year. We're sort of sitting around 178,000, I think, for the last 12 months. But yeah, interestingly, it did pop up as one of the highest areas for building approvals. And I do like suburbs that have constrained supply. So when we did the NIMBY research, there were some journalists that took it different directions. In fact, on Channel 7, it was like Mike from MCG points the finger at this suburb and that suburb. I'm like, oh Christ, my phone's going to ring off the hook tomorrow from angry councillors. But another journalist actually said, all right, well, if you're someone that wants to buy a house and you hate development, or you're a property investor that doesn't want any new supply coming on, you could actually use this research to help select. And I said, well, that wasn't the purpose of it, but yeah, absolutely. You don't want too much supply coming on. That doesn't help the market.
Yeah.
Well, I mean, that's, yeah, sorry, go on, Jeff. Yeah,
no. Yeah. I think that's an interesting point, Mike.
Well, the point that I wanted to make here is what's this that we're looking at here, Melton City. We have 4% of the market is in building approvals. There is 4,111 approvals for Melton City. So although that we're trending down, 215, 4% of the market is coming in the next 2 years. So this is, one of the things, and this market is this isn't an area that we specifically say buy in or not buy in, or say like it just look at the data yourselves. But these are some of the things that you just need to consider. Land supply is a big thing.
Look at the satellite image. Like often that's a bit of a clue. Like I love to see hemmed in areas, like where there's mountains or there's seas, or it's been developed for 200 years, but we're seeing paddocks. I never like to see paddocks, because with the stroke of a pen, things can be rezoned. There could be a government initiative, councils getting a grant if they're, approving a certain number of dwellings, could be open for business for large scale developers. I don't like paddocks around my investment properties.
Well, it is a growth corridor. Like they've earmarked it as where that's sending the population.
They're pushing people to it. The other thing to be aware of is see this geographical boundary. What some now I'm going to say a thing, but I don't actually have any off the top of my head. But you will see that there's geographical boundaries. That this is how they factor in the building supply, and this is where the council is set up. But like sometimes you see all of these geographical boundaries set up around, and it's like, oh my gosh, there's no land supply coming to this market. But look over here, look to the east. There is all of this that is not factored into this council. It's all built out to this area, but this is still technically available to be built out on, which will affect the council that you're in. So you can't just say, well, Melton doesn't have any supply because it's, all up here. Now, to be honest, this area out here is all, inside Melton and Melton West to a degree is quite built out and it is quite established. So if this is a really nice area that people want to live in, it's not necessarily saying that this land supply is going to start affecting if there's enough draw card into the center of the town. And that's kind of like when we look at like the Logan market, right? Logan itself is a massive geographical area that has some of the largest amounts of building supplies coming to the market. There is amazing amounts of new properties coming to the space because of all of these areas. But the areas that have done incredibly well are the areas that have built up enough already. So, your Marsden's, Logan, Lee, where's like Slacks Creek, some of the more nicer areas. I mean, Shayla's Park, all done really well. But people are like, no, don't buy in Logan because there's too much land supply. Well, yeah, just know where you're buying. You don't want to be buying in whatever this is, Park Ridge, but you can buy into an area like Crestmead that is up in here, nice and, landlocked, which will stop any new dwellings coming to.
I'm going to have to really in, Joe. Sorry, man. We're over an hour. And I promised another area. And Mike, so getting on to the depreciation. So stay tuned. This is going to be maybe longer than an hour and a half. So, I mean, we can go as long or as short as you want to, Joe. I mean, I don't know about Mike. But Mike, so I promised depreciation and saving potentially tens of thousands of dollars, depending on how expensive property you're buying, of course. Go and seek financial advice on that from your quantity surveyor and your accountant. Maybe not your quantity surveyor. But Mike, what are the free triggers? Because this question gets asked a lot for ordering or considering a depreciation schedule.
Yeah. The question really is, okay, I bought this place. Is it worthwhile getting a report? Now, I would sort of say, look, I'm going to give you 3 things that if you match one of them, the answer is yes. But I would also say ask a quantity surveyor because no one's really going to charge you for that, right? And so no self-respecting quantity surveyor is going to say, yes, it's worthwhile to get a report when they know they're only going to get similar deductions to what the fee of the report is. But the 3 triggers are, number 1, you bought a brand new property. Now, we're not advocating that, but if you have bought a brand new property, it means it's completely
made one,
or built one. Yeah, buy or build. Yeah, it's really it's similar. I mean, the methodology that we have is a little bit different, but from a depreciation point of view, it's 100% undeducted asset. It's got all of its depreciation there. Nobody's taken some of that from you as a previous owner, and of course, it means that the 2 main components of depreciation will qualify: the plant and equipment items, which are kind of the loose assets like your ovens and cooktops and carpets and split system air conditioners, and then Division 43, the structural components, which is, the bricks and the timber and the gyprock. So we kind of know new property is good. The second one is if it's built after the 16th of September 1987. So that's the cutoff date to claim depreciation deductions on the original building structure. So if it's built after, let's just say 1987, it's easier to remember, then it means the bricks and the timber and the concrete and the fences and all of those things will qualify. And let's just say a property cost $100,000 to build in 1990, then you're getting 2.5% of that as Division 43 or capital allowances. So $2,500 worth of deductions per year. Is it worth paying $600 or $700 to get a tax depreciation schedule for $2,500? The answer really is yes, unless you have no income or there's something weird about your situation. So the first 2 I think are easy: brand new or post 87. The third one is where people get it wrong, and accountants get it wrong as well. Not all accountants are created equal. I think if you've spoken to a few accountants and then you speak to someone like Jeremy Yanazelli, who I know is a fan favorite of this group, you'll tell the difference straight away. He's a clever guy. He understands it. But we've certainly had people come to us and say, my accountant said it's not worth getting a report, but I saw you on Ozprop, or I listened to you on a podcast, or I read a blog that you wrote, and I just kind of want to maybe double check. And they're a bit sheepish because they feel like they're going against an advisor's advice. But a lot of the times the accountant has given them the wrong information. And what the problem is they've said, okay, the property was originally built in 1970. So the accountant said, well, there's no depreciation deductions available to it because it's built prior to the cutoff date for Division 43. But what they refused to do is look at the history of the building. So if that has been renovated by the previous owner, or let's just say the owner has renovated themselves, then it can be a completely different story. I even heard a quantity surveyor once say, new property is always better for depreciation deductions than old. And I sort of said, well, yeah, it doesn't sound that, yeah, I mean, it is controversial, but it sounds kind of intuitive, but it's just when they say always better. So let's say you buy a brand new project home, it costs $350,000 to build, you know, you might get, let's say $16,000 in the first year worth of deductions, but you could buy a blue chip property in a capital city that was built in the 1920s, but has just had a $2 million renovation on it. So it was built over 100 years ago, but it's actually going to be better for depreciation deductions because of those renovations, because of those improvements. So they're the triggers. You buy a brand new or a built after 87, automatically worthwhile. If you buy something before 1987, you need to investigate the history. And what we want to see is around $40,000 or $50,000 worth of renos at a minimum. Now, it can be hard to look inside a property and go, oh, I think there's roughly $85,000. That's what we're qualified to do. But if it's had a new kitchen and a bathroom, you don't get much change from 50 grand anymore. If it's been extended or if it's been completely gutted and refurbished, it's going to cost a lot more than that. But as I say, give the address to a quantity surveyor and get them to look it up for you. They're not going to charge you for that advice. And if they think it's worthwhile getting it done, then you can go ahead with the report from there. How's that, Jeff?
There you go. That was succinct. I like it. And somebody's saying, oh my God, Mike the Beard didn't even notice you. He thought you were AI or something. He said, is this from 20 years ago or is an AI filter? No, that is Mike's actual beard.
It's not. I don't know how to, I actually
Andy
had
Murphy
someone.
said that.
I actually had someone that I met at a conference, a rather high-profile property person who was looking at me doing stuff and just assumed it was an AI filter. And they expected that when they saw me in person that I was balding and I was just trying to throw people off the scent. I have no way to prove that I'm a real person, but, this is real hair. It's a real beard.
Solid.
So
you can do it. I've met him in real life. Those plugs are legit.
The plugs. I mean, I love a trip to Turkey like anybody.
Yes. No, but one of the interesting things that I think is worthwhile, Jeff's not. I've been buying property for a little while now. And Mike was like, Joe, you got to, and so was Jeff actually. But he's like, Mike, Joe, you need to run all your properties through a depreciation report. So I've sent Mike every single property that I've ever purchased. The average year based across every single property. So there's a lot lower and a lot less, a lot more is 1987. And the average return that you have given is 2,000 to 4,000 as a return. And the average year is that. So just because the house is built, what was it? Actually, 1987 was the date that you gave us as the cutoff period. There are so many to be the average. It means there's half, there's more on this side, there's more on that side. There's still money to be made, even if it isn't on that side of 87. Yeah. So keep making that conversation.
Yeah. And
why do we even do this? Because tax, why are we paying it? I mean, I get why we pay it, don't get me wrong. But why do we deliberately give the government that $4,000? Pay the $600, $800. Anyway, sorry.
I'm going to wheel it back rabbit hole because I promised another suburb and then we're going to get, so let's throw second. So,
I don't care about any of this. All I care about is I just did a renovation, Mike. Jeff and I just did a renovation. We just spent, how much did we spend? We spent $55,000 plus stumping for $71,715,000 on a renovation. We bought it for $530,000. It's now worth $630,000. 35 or 45. I forgot what the valuation came back. So I want to know how much money are we going to get back on depreciation? Because we are taking, do you know what the year is of that property? I don't remember what the year is.
I feel like it'd be in the 80s, probably 80, I don't know, late 80s, early 90s, perhaps.
Yeah. So Mike, you've been kind enough to talk through our renovation because I gave you line by line. We painted the interior of the property, including ceilings, walls, trimmings, and doors. That was $11,000. Jesus Christ. And you flagged that one and you flagged all of the points. So maybe what would be the best way to talk about this renovation and the
Can we share the
savings?
spreadsheet maybe, Joe?
Before we do that, let's go to the sponsor, Joe, because that'll take us half an hour for that one. And we'll come back.
Okay, so
it does take a long time.
Stay tuned, everyone. Otherwise, Jeff's already up and running.
He's left.
Hi all, I've got a big problem.
Running the wrong bloody ads.
Everywhere you look, someone else is making money in property except for you. Your mate, he just bought a house. It's already gone up $100,000. There's some bloke on Facebook. He's bragging about pulling in a 7% rental yield. Meanwhile, you're stuck scrolling real estate and domain, confused as hell and having no idea about where to start. Or maybe you're that mate that's got $100,000 in equity. You have a few properties under your belt, but you feel stuck. You're unsure about how to scale without over-leveraging and not knowing what the next right move is. So why does it feel like everyone else has some kind of secret that you're missing out on? It's because they do. There's a reason some people keep stacking properties while others sit on the sidelines stacking excuses. There's a reason why some investors buy under market value while others pay too much. There's a reason why investors know the hot spots before there's any heat. And there's a reason that some people build $150,000 in passive income while others just spend years thinking about it. And it comes down to knowledge. And that's exactly why Jeff Miles and I, Joe Tucker, created the Level Up Property course to hand you the exact step-by-step process that we've used to buy over $100 million worth of property in today's market. We've built Australia's largest property investment community with over 80,000 members, and we help everyday investors secure hundreds of thousands of dollars in equity, all without wasting years of their life trying to figure it out the hard way. Making an uneducated decision on the biggest purchase in your life is just gambling with your future.
Stop it. Get some help.
And this isn't just another how to buy property course. Let's be clear though, this course isn't free. What? And neither should it be. This is our life's work. We've spent over 100 hours each on this course alone. Oh, babe. Okay, video number 3. Number 4 with million does... Fuck. Done. We've got decades of experience, millions of dollars in deals distilled into a repeatable process that you can take away for yourself. If you're looking for free advice, there's plenty of noise out there. You can go and find that if you'd like. But if you want real, actionable, step-by-step guided process that works in today's market, then this investment is going to change everything for you. By the time that you finish this course, you will have full confidence. You'll have every tool that you need to build an amazing portfolio if you act on it, right? Which is why we have mentoring built in. So we kick you up the butt to make sure that you're kicking your goals. So the real question is, how much longer are you going to watch everyone else making money in property before you jump in and start playing the property game properly? Because the sooner you start, the sooner you start winning.
We are back.
I say.
I did. Yeah. So we're going to unpack the Reno, and there'll be one more suburb. So if you don't know how long we take this. I promised 2 suburbs. So let's do one in the east as well. So if I see a recurring suburb, maybe we do Pakenham. Do people want to see that? But first off, do you want to go through the spreadsheet? Show us how much you're saving us on that Oz property reno. We spent about roughly 70,000, Joe, was it? Give or take?
Yeah, so we spent $71,715,000 on this property. Now, Mike, I also want you to help point me to any problems that you see with our renovation. For instance, you know, we did some floor. Oh, did we do flooring? No, we did some plastering. But like, what should I be putting down? Should I be putting those floating floorboards, or should I be putting carpet? Like, Feel free to point out any like opportunities. Now, this spreadsheet isn't pretty. It's just a spreadsheet that I have used to track the numbers for the deal. So this is all the work that we did. And I'm just going to rattle it off really quickly. So to give people context, repaint the whole property, ceilings, walls, trimmings, doors, repairing cracks throughout the house, removing a wood heater and plaster the ceiling, building a wall and a door to make a 4th bedroom, plastering walls and ceilings, close the doorway to the kitchen, build a wall. He's charging us a lot for this wall. He's mentioning it quite a few times. Move the light switch for a new wall. He's padding the shit out of it. Remove and replace the kitchen ceiling, repair and repaint the ensuite ceiling, removing all the mold, replace 2 glass panels in the kitchen cabinet. All of that together was $5,650. So for you, Mike, you might be a little bit upset actually to see that number, because it's like, it's not a, do we want to get a line by line item? Answer that question. I'll just finish the rest of what we did. Reseal, regrout shower and floor, replace fallen out grout throughout the property, main bathroom renovation. So this was a big one. It was only $15,400, which is great. We removed and replaced all the plaster. We built a new shower, complete new plumbing, waterproofing, tiles and wall to ceiling tiles, which was very good. 15 new windows and window winders and lock, replace the bathroom taps, including installation, light switches throughout the house. Oh, he's charged us twice for that, because I just paid him another $800 for that. Supply and install new split system and a rear door that needed to be replaced. Still going. Repair and stain the back decking, power washing, high pressure washing, oil contouring, cleaning the gutters, repairing the eaves, installing a new mailbox, garden to be tidied up, replace back fence, removing air conditioning from the window and replaced with glass. That was $350. That's actually a really good price. There's a lot there. Sorry to bore you, Jeff.
No, not just me.
But that was all the renovation work.
We don't need to know every single line. Anyway, go on.
I think you do. But okay, now what?
What does this mean? You guys need a holiday.
Yeah. We need a divorce.
So what I did is I jumped in and I put the category, I put Mike's notes and put nothing in that. So that was really helpful. Effective life depreciation rates. I've just chucked in the depreciation rate and a first year claim for everything that's applicable. So the one thing that I wanted to highlight is that people need to understand the difference between a depreciable asset and repairs and maintenance. And it's something that the ATO have said really for the last 5 years they're targeting, right? So what is actually better, a depreciable asset or repairs and maintenance? The answer is repairs and maintenance, because it's an immediate deduction. However, the tax office says there's a difference between repairs and maintenance of an asset that's already income producing and you buying a property that needs to be fixed up in the beginning. So I didn't know the exact situation, but I assume that this was a new purchase and an immediate reno. So you wouldn't have the applicability of the repairs and maintenance. They would need to be depreciated over the effective life. And the effective life of most of those improvements is 40 years. So if you look at
40?
the total 40 years.
So
yes.
40 years or instantly.
Yeah,
those are
you
the
can
options.
see which one's better. Do you want to wait 40
Jesus
years to
Christ.
get your money back, or do you want to get it back in the year that you spent it? So that's why people do go for repairs and maintenance where they can. And repairs and maintenance also has some nuances to it, even when it qualifies. It can't be a replacement of an asset. It has to be a repair or money spent on something that stays in place. For example, if you put a new widget in a hot water system, then that would be repairs and maintenance. If you have to throw the hot water system out and put a new one in, that can't be repairs and maintenance. That would be a depreciable asset that has to depreciate over its effective life, which will be 12 or 15 years, depending whether it's solar or gas or electric. So if you look at that list, you could probably say, okay, well, if we look at the total, the worst we can claim is a 2.5% on the total. And I think that works out to be around about $1,500 on the whole thing. If you scroll a little bit to the side at the top, I
Wait,
made a little...
1,500 or 155? You've got
155. So that's 2.5% of $5,650 plus GST. So that's what you can actually claim in the first year on that one asset. If you scroll up to the top and to the right a little bit, I made a little, maybe you deleted it? There was a little turquoise thing. Yeah. So see that button where it says there's an N in that K? So it's saying if yes, then repairs and maintenance, otherwise division 43. So if you change that to a yes, you'll see some magic happen where all the repairs and the maintenance become an immediate deduction, and you can see the total of the first year going through the roof.
What?
So in K, where there's where it says there's just an N in that K column.
See this, yeah. Oh,
yes. If you change that to it'll have to be a capital Y, sorry, then that should actually show the value of the repairs and maintenance coming in. And if you look at that total, you can see it's actually just over 10 grand. See where it's 10,000 on that yellow line?
Okay, sorry. This is it's hard when it's so. Okay, so what are we talking about here? So we can.
So
claim
what I'm doing is I'm saying, let's
$2,000.
say you did this renovation a year into the rental, you would be able to claim $10,000 in that first year rather than $1,900.
So incredible.
10,000.
Okay, so
388 would be the claim in that year if those assets were actually, which were repairs and maintenance, but they were initial repairs, not ongoing repairs. And that figure there, I didn't realize the stumping was on top, so I was using that 55,715 as a total figure. So if we just look at that 55,715 spend on the reno, in the first full year of claim, you've got $1,969 worth of deductions. So how much was the stumping?
16.
Is that the only 16? Yeah. So if you're doing $16,000, a quicker way to do it is to divide by 40. It adds $400. So you're nearabouts to $2,400 worth of deductions in the first full year of claim with that what would that be? $70,000 spend.
And then I get this $2,400 for the next 40 years.
Not exactly. It's not quite that simple. So there's a difference between the Division 43 assets and the Division 40 assets. So you can see anything that's depreciating at 2.5%, or I've got in there at 0.025 because my weird little Excel formula, that depreciates at 2.5% of its value each financial year for 40 years. So you could actually buy a property that has had a Division 43 asset installed 10 years ago, and when you buy it, you've got the 30 remaining years. But there are some plant and equipment items there. So for example, you put in an air conditioning split system that actually has a 10-year effective life. So that gives you a depreciation rate that you can claim over the life of that asset. And depending on your method of depreciation, it gets a little bit funny. But I think because Jeff is wanting to get on with other stuff, we can probably
we can make this a 2.5 hour session. I mean,
it's already 1:30. It's already been an hour.
Just that split system itself, which is around about $3,000. Well, what was that giving us? That was giving us $680. $627 just on that one item.
And sorry.
So the smart move on this renovation would have been to, in fact, I mean, from a tax perspective, is do as little as possible, get a tenant in place, and then do a whole heap of the other stuff, because then I would be able to instantly write the asset off rather than having it effectively depreciate over the next 40 years. So anyone that is, go on.
But how are you getting the renos done with the tenant in place though?
I mean that is the thing, right?
Yeah, that's the problem, right? Like you've got to overlay reality. And to be honest, I don't have the time, energy, or effort. Neither does Jeff to like work out. Okay, we're gonna get this done and this done and this done, and then it's like drags it out. Then you piss the tenant off. So you do have to think about it, but if we did think about, like, I look at this renovation, Jeff, and I'm like, fuck, we could be at 10 grand that we could instantly write off in year one, but we're now writing off only 2,400. Should have just for an extra 5, 10, an extra $6 grand. We should have.
And then you probably we'd have to offer the tenant discounted rent, and there's all sorts of permutations. So
yeah, but there's so much stuff that you can. I mean, a lot of it: clean the gutters and eaves, installing a new mailbox, decking, pressure, water, and restain, replacing broken downlights throughout the house. You can do that. It was the light's broken. Oh, sorry, I should have done that before. Yeah, free rent. There you go. You're still saving money.
It's a good point, but people don't make a lot of decisions based on the tax treatment. And to answer your question, what should you do? Well, you asked a question about floor coverings. So say, for example, you're tossing up between tiles and carpet in the living areas. Well, carpet's considered Division 43, so that'll give you a 2.5% claim. Carpet is a plant and equipment item, used to have a 10-year effective life. It actually has an 8-year effective life now. So that's actually a 25% depreciation rate. So it's 10 times more beneficial to put carpet in than tiles. Floating timber is a similar one. That's a plant and equipment item. So is vinyl or lino floors. But the actual hard timber board, so, like the big long planks, polished concrete, tile, these are all considered part of the building structure. So that's where I think, I said some years ago, and for some reason people remember stupid stuff that I say, but I did say once that I reckon you should actually carpet your bathroom and carpet the walls. And I actually someone sent me a photo of a bathroom with carpet on the bathroom. I definitely don't recommend that. It's one of the grossest things out. But if you were just doing things for tax purposes, that'd be the sort of stuff you'd be doing.
Okay. Well, let's do it. Okay. Well, that was very good. So thank you for doing that. This has benefited us greatly. We now know but also the thing is, the report's going to cost us $650 to do, and we're going to save $2,000 that we wouldn't have saved otherwise. So
yeah, look, if you're on a 45% marginal tax rate, you're talking over $800 back in your pocket in the first year, and the tax depreciation schedule is also tax deductible as well. So it would be worthwhile to get a depreciation schedule just on that reno. But hopefully it also elucidates the fact that you could have bought this property and the previous owner did that, but we can actually go in and identify what they've done and you can claim those deductions. The only thing that you can't claim is the plant and equipment, because ScoMo changed that rule on the 9th of May 2017 before he went on to be Prime Minister, and then Scotty for marketing and bushfire response.
Yeah, head in the sand in Hawaii. So, gee, we've gone down a lot of. We could talk. I'm not going to go down the prime or depreciating method sort of thing, because that will.
Yeah, we don't want to go down that bloody rabbit hole. We'll have too much fun, and it would upset everyone. The other thing to mention, just while we're rounding this conversation out, Mike, is that we've said here we can claim $2,400. Is that just the renovation? Can we also claim more on the actual property and the dwelling and all the other stuff that's in the property, or that's going to be the number that we're going to get back at tax?
That is all I've looked at was the reno. So I have no knowledge of the original property. Cool. I took that in isolation.
Still more opportunity there.
Yeah, so it could be that it's built after 87, so we've got some structural claims, or if it's not, it could have actually had the previous owner could have done some renovations or improvements as well. So that is really a minimum figure that you're looking at.
He did renovate the bathroom and did a really shit job, so we had to make a new bathroom. So I don't know if we can claim,
if it doesn't sort of stay in place, then it's not really part of the income producing asset.
Appreciate it. What are we going to now, Jeff? What are we talking to now?
Well, I promised 2 suburbs, so I was trying to fit 3 in, but
well, we're not doing 3. We can do 2.
Well, we could have done 3.
What's the other
anyway? Well,
let's go.
Everybody's saying that Greg and Karen and people want to see Fern Tree Gully. So I personally think this
Vegas.
Fern Tree Gully is in the west east of Melbourne. It is very owner occupied. So I'm not so sold, but we'll run through this process and just look at the data. It's too expensive for mine, but let's have a look. We'll run through that and then we'll get to wrapping up with some great questions. So, Mike, do you have much information on the Fern Tree Gully? I believe it's in Knox, perhaps the Knox LGA. What have you got on? You got?
No, I wasn't aware that we were going to dive into that one, so I've got nothing to hand.
That's
But
okay.
yeah, look, in some of the research reports, you should probably see that suburb popping up in terms of the dwelling approvals and those sorts of things. But yeah, I'll leave it to you guys as the resident hotspotting experts.
Well, yeah.
There we go.
I'd say warm spot. Let's say warm. So are we bringing up hashtag in? And we do have the. I'll throw the discount there now. It is a 20 to 20. Here we go. He's got it up. So this is why it's too expensive. Like over $1 million.
$1 million bucks.
Yeah.
On a 2.91% yield. So that would be negative $50,000.
Approximately.
No, more than that.
They're pulling our legs here, Joe. The audience has led us astray. But let's carry on down.
But the thing is, I mean, this is the thing with capital growth and yield, right? Like if you've got $1 million property and it has a 92, like it's a score of 92, and it's going to grow. If we go back to the data that our man Magic Mike had, and this Stowington East, I mean, is going to grow $428,000.
May grow. No,
obviously, sorry, not is. We can't say, we're not saying, but it's delayed and it's lagged behind 420. I would pay $40,000 every single year if I can get $400,000, right? That's the entire reason for investing. So I wouldn't just discount it straight away to say that, oh my gosh, this place isn't worth buying because it's over $1 million. But you do need to be. Yeah, you do need to be able to balance the cash and equity, your borrowing ability and serviceability, and most importantly, what a lot of investors struggle with is the cash flow. And the cash flow on a 2.9% yield is going to leave you very negative. But let's talk through the data. What are you seeing in here? What's jumping out for you, Jeff? One thing to note is
what I'm seeing is what I'm saying is we look at the 3 years. If we look at 10-year capital growth of 67%, so you're sort of saying, okay, over the 10 years, it's grown on an average 7 years, 31. So the thing with these median house prices, they may sort of be a bit off. So you need to actually understand what properties are selling for, whether that be from realestate.com, whether it be any data provider. So I'm seeing that, yes, it has seen some reasonable growth for the last 5 years, 27 to 30%. That's not bad. Look, it's not, everybody gets used to this sort of 20 to 30% growth per year, which, I don't think is achievable and realistic. But go down again, Joe, have a look at the affordability, and that'll potentially tell a story. Rents have grown a lot as well. So affordability is not actually looking too bad, which tells me that the IRSAD, so the socioeconomic status is at about 7. So a nice owner-occupied area, 79% owner-occupied, which tells me
that's
that
massive. 21% renters to owners. That's quite low.
So probably a tightly held area. If you look at average hold period, you're probably talking, I reckon, could be up between 12 and 15 years, perhaps. I haven't looked at this before. I'm just hold period.
Yeah, 13.
I do love a low percentage of renters as a metric, because we know for a fact that owner occupiers spend more on their properties than investors do. And we've seen that in our own data. We actually looked at the percentage of property investors that renovate their property in the first little period of their ownership. And we know that 25% of property investors actually live in their property before they rent it out, according to our data. And the ones that do live in it, rather than renting it straight away, they spend almost double other people. So that's a fairly good indication as well.
Wow. Yeah. And also, like, if on a street there is all of these areas, like there's 5 houses and 3 of them are being renovated, that's going to drive your property, although it's not as nice and although it's not as renovated and it's not as good, you're getting dragged up from the bottom. So when people are like buying in a median house price suburb for $700,000, that is the median, and you're buying a $900,000 property, I would rather buy in at the 600,000, because you're going to get dragged up as things start to improve and as things start to get better. So try and buy below the median, because you'll be dragged up with the owner occupiers pushing up the prices. And that's kind of what I like.
I'll say to that is just make sure that you're not overpaying and buying in a not
Yeah.
spot in that particular suburb. So just be
Yeah.
mindful that you're not behind
Yeah,
the main road.
actually, yeah. I mean, the price really does come down to the area that you're buying and also the type of asset that you're buying. Because if we have a look here, the median house price is $1 million, as we said. The majority is 3 beds. So the 4-bed properties in this area there's a lot less 4-bed demand. So you will see that actually a 4-bed property is probably $1.2 million. A 3-bed's probably 800 to 1 million, and then there's not many 2-beds. But yeah, in terms of stock, very, very low listings, taking a dramatic turn. Inventory levels, this must be a very tightly held suburb where you can't build out anymore. Like properties are flying off the shelf. There is only a month's worth of like a month worth of supply available. So the properties that are on the market are quickly getting taken off the market, and there's no way to build any more properties. There's only 25 building approvals, which will probably be the infill of the area, and people want to live there. They want to hold their properties from a long term. So that's a supply side of things. This is the story that we can't drastically change. This is the things that are, take a while to change. So the demand side, what are you seeing in this data?
Days on market is been pretty flat for the last couple of years. Like that trend which is just interesting. So
this is why you don't want to look for one trend, like one piece of data, because the data here is like, oh my gosh, this market's only at 20% days on market. It's not really enough to tell the entire story.
Yeah. The other thing you kind of, so there's a reason why it hasn't seen capital growth, and that's probably because you've had interest rates kind of go up, you've had the investor sentiment, but you haven't seen a decline of properties value largely in this area. So days on market, vacancy rates is kind of about average. Like you're sort of, you're not under 1%, but you're not like above 2%. So you're sitting in that sort of, 1-ish percent. Yes, there was a couple over that sort of Christmassy period, perhaps. So, but the trend line's kind of looking there. Look, so this, from a data perspective, this looks reasonable. Should you be buying there? It comes down to your strategy. Like, if you can afford to hold it, maybe, but are you better off sort of buying those 2.5 or 600K properties and getting probably better cash flow? It comes down to your financing situation. So, like, I hope that's been useful for people to see that analysis. It's been slightly rushed because we're poor Mike's got if you look at the growth rate cycle, so you didn't even go into a negative sort of growth rate cycle. So that's where the high demand or the high tightly held can play in your advantage. But that's, of course, if you can afford the 8 to the 900K plus property prices with that rental amount.
Yeah.
There we go.
Good stash.
But what I wanted to say, Mike, because there's been a couple of questions on depreciation that have come through. It's Golden Square. Everybody wants to talk about different parts of Victoria, which we specifically said Melbourne, but somebody said, I think you could probably still get in. So Charles asked, is it too late to order a depreciation schedule for this year?
The answer is no, because even if you have depreciation entitlements for this financial year, you don't even actually need to order it straight away. You really just need it by the time you meet with your accountant. The only timing thing that's an issue is if you want to claim the fee as a tax deduction, you need to pay for it before at the end of June. One thing on timing, though, and this sort of relates back to what you were saying before, Joe, about, why do we leave it on the table? Why do we tip the government? You can only back claim 2 financial years worth of deductions. So if you went and did your tax return and you didn't have a depreciation schedule, you could pay a fee next year to go and amend that previous year's return, but you've only got 2 years to do it. So a couple of years ago, we did a research project where we looked at 1,000 residential investors that came through our doors, and we found that 6.7% of them waited so long that they missed out on deductions, i.e. they waited more than 2 years to get in touch. The average amount that they missed out on was $20,537 each. And if you extrapolate that across the investor population, so I think at the time we did that data, there was 1.4 million property investors. You give 6.7% of those, you times that by that average 20,537, it was actually $2.88 billion worth of unclaimed depreciation deductions. And I always like to check if there's someone online from the ATO before I say this, but whatever, it's 9:18, they're already in bed because they're not cool enough. My mission is to deny the federal government of tax revenue through entitlements that are written into legislation. These aren't loopholes. These aren't tax loopholes. This is actually written into the Income Tax Assessment Act of 1997. These are your entitlements, so you should be claiming them. So the answer is no, there's still time to do it, but don't wait 2 years and be one of those statistics.
Don't be a statistic. That is rule one. The other thing is a great question that's popped up here. If I live at the property and I rent out individual rooms, can I get a depreciation schedule?
Yeah, you can. There's normally two ways that accountants will kind of pro rata it. So we'll do a depreciation schedule on the entire dwelling and the accountant will pro rata it. So they might sort of say, okay, well, you're renting out a room and it's, let's just say, 20 square meters, and it's a 200 square meter house, so you're getting 10% of the deductions of the whole house. Or what they might do is, okay, well, it's a 3-bedroom house, you're renting out 1 bedroom, so you're going to get 33.3% of the total deductions, because a house is not something that you can just give someone a tiny corner of. I mean, they still have use of the air conditioning systems, the hot water systems, the bathroom. So that's the way to do it. But yes, if you're partially renting it out, you can claim the deductions. But once you start putting that all on paper, the deductions, claiming the income, then you are exposing yourself to capital gains tax. So you want to make sure an accountant is along there to advise you as well.
Definitely. Yeah, I was going to say that. Like, is it, are you sort of robbing Peter to pay Paul? I mean, depending on how you want to run that.
I've done it myself. Yeah, it's a question that you have to ask yourself and model yourself. But the first ever property that I bought, I rented out a room. It helps me sort of to pay for it. I got a CGT, partial bill at the back end, but I got some good cash flow along the way. So that was more meaningful to me to claim immediately than worrying about, a little bit of CGT at the back.
Yeah, and you're going to be wealthier, like I would hope, than previous 4-year-old self. It's not something you want to aim for, but I see my 4-year-old, in 4 years' time, or 10 years' time, or 8 years' time, whenever you plan on selling that asset, I'll probably be wealthier than I am now. So if I need the cash flow right now, I'd rather take the cash flow while I can and rob Peter and pay richer Paul later. Sorry to upset you there, Jeff.
wanted to give a shout out to hashtag. We did pop the discount code in, so we got 20% off, I believe, 2025. So that's So check those guys out.
What do people have to do? They have to put
click on the link in the comments. There is a link in the comments. Jump on that link in the comments. I've just put it in there. And people, if you've gotten value from this deep dive into the data, the truth behind Melbourne, give us a 5-star. We are almost getting there in Spotify. So that is, share this because we want to get this information. Mike wants to deny the deductions for as many people as what he can. So get this content out there to as many people as we can, people. Give us that rating and share it with as many people as you can. But Mike, this has been a great session. Joe, where do we go next? Let's wrap us up.
Thank you.
Okay, let's wrap this sucker up. Mike, how do we get more of you in our lives?
Well, that's I don't think anyone wants that. But you can, I'm easy to find. I'm on Facebook, I'm Instagram. I think that's a QR code to my LinkedIn. I would encourage people to go to our website, to mcgqs.com.au/research. All of the stuff that I've been talking about tonight is in these research pages. So we've got the mean reversion, we call it the price gap. We've got the NIMBY reports. I've got the landlord exodus stuff. These are all things that we spoke to, but I'm a pretty easy person to track down.
Well, I think it's just, I think that, it's funny. Ever since I sent you that list of properties, it's incredible how much older properties can claim. My rule was my rule for depreciation was 1987. The rule, like when the year happened, it blah 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 blah. To change the rules, 1987. That's the thing. Not the case. Absolutely not the case. You can save 2,000, 3,000, 5,000, 10,000 because your property was renovated and someone else has renovated. Someone's done all the work. You can claim deduction on it. So my advice is just to do it. And there were a lot of properties that came up that were like, nah, does not benefit whatsoever. Sweet. Cool. Because don't you the way you work, Mike, isn't it like if you don't like you're the team, if you don't make the cost of the report, you just say don't do it. Like
we look for double the cost of the report in deductions in the first full year of claim. Even though the reports last for 40 years, we really want it to be paying for itself within the first 12 months. So we're looking around $1,200 or $1,300 worth of deductions in year one. And then of course, if you've owned it for a couple of years and there's a back claim, it might only be $800 in year one, but if you add the $700 and the $650 from previous years, then it might work out. So we're always happy to say, look, this is where we're at. You can give that to your accountant and say, is it worthwhile getting the report when the numbers are close? But we do a lot of that for you. Christy, I don't have a discount code, but if you get in touch with me or the team and you mention Oz Property Investors, they have been well drilled to know that there'll be a reduced fee for anybody. So feel free to do that.
And we do not get a kickback or referral for anyone that uses OzProp or anything like that for Mr. Mike. But should I do it every year, Mike? Should I be doing depreciation this year and then be doing one next year and then one the year after on the same property?
Yeah, we get those questions every year, and that would be great if we could have recurring revenue source like that. But the general answer is no, especially if nothing has changed. If you've undertaken major renovations, you need to update it. If you've added one or two items, you can give that to us and we'll do an update free of charge. You can also give it to your accountant as well, because accountants can't estimate costs, but we can. But if you've done work, you'll know what the cost is. But generally speaking, it's one and done unless you're making changes to the property.
Incredible, mate. Thank you very much for taking the time. Thanks for putting that all of that data through. This is some of the stuff that, like, I like the data that you send through because it's like actual investors that are actually putting their money behind something. So yeah, let's go buy a property, guys. Thank you very much, Mike.
Pleasure.
Anyone that needs a depreciation report, let's go depreciate some property.
Melbourne. Let's go.
Now you have the truth. See you.